This is part 2 of our Q&A series. We posted the part 1 of this video a month ago. If you have not watched that video, watch it here. We got a lot of love on that video and a lot of people found it really helpful, and hence we are shooting this video. Now, all these questions have been extracted from the comment section. So if you have any question that you want to ask, please post it in the comment section. I try to answer all the questions in the comment section itself, and if the comment can help the wider audience, I'll keep making these videos. So let's begin.
Is Nifty Next 50 Index fund is passively managed?
Yes, the short answer is yes. Now to explain it a bit further, if you have not watched this video where I've explained about what is NSE, what is BSE, what is Nifty, what is Sensex, please watch that first. I've explained entirely what exactly is an index, how to see all the indices. I've also shown it on Money Control as quick demo to see all the indices there. Now, if you know about the market capitalization, if you don't know about it, again in this video I've talked about market capitalization. Now, rank 1 to rank 50 based on market capitalization, this is called as Nifty. And if you go a bit more further, rank 51 to rank 100, this is called as Nifty Next 50. So it is also a passively managed fund and you can invest in it, and these are the companies that have a lot of potential to enter into Nifty, because if they grow, if the market capitalization grows of these companies, they would become a part of Nifty as soon as they beat the 50th rank and something comes up.
I'm having 28 plus stocks plus some ETFs in portfolio, but if I'll be able to manage this, then will it be a good portfolio size?
Okay, the short answer is yes. So basically in this video I talked about how to build a great portfolio, in which I explained you should never invest more than 5% in any single stock, which basically means overall you'll have 20 stocks in your portfolio. But you'll always realize that you would be breaking this rule a bit, and sometimes you would be having less than 20 stocks, and that's okay. In your example you have 28 plus stocks, and that's completely okay if you can manage those stocks. That is very important. When I say 20 stocks, it is a very important number because 20 stocks I can actually track. Every quarter I can see their reports. In your case you'll have to do a bit more work because you'll have 28 stocks to track. Along with that, if you can actually manage the volatility and everything else, it makes a lot of sense to have these 28 stocks. Plus you said you have ETF. That also makes sense. ETF is passively managed. You don't have to do a lot of research in ETF, and that's also completely okay. See, portfolio building is a very personal thing. What we are trying to do here is we want to have a portfolio that works really well irrespective of the market conditions. When there's a bull run, it gives us more return. When there's a bear run, even then it doesn't fall a lot. With your 20 plus stocks, I hope the whole portfolio is well diversified among multiple sectors. It has multiple stocks of small cap, mid cap, large cap, and all those things have been taken care of. If that is the case, you are good to go. You can have 20 stocks. Try to reduce a bit if you can. If you cannot, it's okay. Completely okay with that as well.
Can you clarify how to do tax harvesting in small cap fund or in fund which is not allowing lump sum investment? Because to book profit and again reinvesting के लिए initial amount तो भरना पड़ेगा ना.
So I think you got tax harvesting a bit incorrect. It does not really matter if you have a small cap or a mid cap or a large cap. It does not really matter. What here matters is every year 1 lakh long-term capital gain profit that you get is non-taxable. Now you can get this from small caps or mid caps or large caps, does not really matter. Now to answer your question, wherein for example I have a small cap fund which is not allowing lump sum, and I book profit in that small cap fund, and now I am not able to reinvest again. In that case, you'll always have plenty of other options to invest. For example, if I have, let's say, Navi small cap index fund and it is not allowing me to do more lump sum investments and I book profit in that, I can always go with, let's say, Nippon small cap fund, or let's say Motilal Oswal small cap fund or something else. There are thousands of options available in the market in terms of mutual funds, be it index fund or actively managed fund. So you'll have a lot of options. What you have to care here right now is you have 1 lakh rupees that becomes non-taxable, and that too only in long-term capital gains. Just maximize that using small cap, mid cap, large cap, does not really matter. And if you don't have the same fund available after you sell it, or you can always have a lot of options available because there are 10 plus AMCs in Indian stock market. You can always use these AMCs to buy some other fund from some other AMC.
What amount of money indicates financial freedom?
Okay, a really good question, and in fact a very personal question. I won't be able to answer this on your behalf. I'll tell you why. because for every single person the expenses are different, and financial freedom is defined by the amount of money you have based on the expenses you have per month. Now to answer you, in a simple language, I would say, what's your monthly expense? Now let's say your monthly expense is 1 lakh. That is your expense. This is the money you spend on your lifestyle and you can't reduce it. Automatically it will go a bit more up because you'll have more responsibilities in future and you'll also have more inflation, so this is bound to go up. Now if you spend 1 lakh per month on your lifestyle, that basically means you spend 12 lakhs per year on your lifestyle. Now there are a couple of rules that people follow. One very important and one very popular rule here is, if you have 30 times your annual expenditure, then you can call yourself as financially free. In this case, since you spend 12 lakh a year on your lifestyle, if you do 12 into 30 years, that brings us to like 3.6 crores. That basically means you would need 3.6 crores to call yourself financially free. Now, another very important thing here is to remember that the withdrawal rate should be less than 4%, because you'll also have to factor in inflation. So you should have 3.6 crores in your account that should be growing. Along with that, you should not be withdrawing more than 4% every single year. Only then this money would always be there. Otherwise you'll just exhaust all this money, plus you'll also have to factor in inflation. Inflation is almost like 7-8% in India. So this is how you can calculate your financial freedom wala logic. It's very simple and straightforward. So example, you have 50,000 monthly expenditure, then you can do the maths accordingly. Then it would reduce it down to like maybe 1.8 crores. So you can do your maths simply 30 times into your yearly expenditure. That will bring you to this number of financial independence. And then withdrawal is very important. Do not withdraw more than 4% after you reach your financial independence and you stop working for money.
Want to ask, should I invest one time or monthly in ELSS mutual funds?
Always go with SIP when you go with ELSS mutual funds. See, I am guilty of doing it lump sum investment in ELSS funds, because I think 2 or 3 years back I forgot to add those SIPs, and then in the end when I realized I have to do tax savings, in the month of February I did a lump sum investment of 1.5 lakhs to save my taxes. But generally I would suggest you always go with SIP. Since you have 1.5 lakh which comes under ATC, that you can invest in ELSS funds, out of this your employer would be paying you PF, so reduce that because that also is a part of ATC. Let's say your PF is 30-40,000, that brings us down to 1.1 lakh. In that case, make your SIPs in such a way that you exhaust this amount at the end of the year. In that case, have a SIP of 10,000 per month. That basically means at the end of the year you would have invested 1.2 lakhs, you would have saved your taxes, and you would have also benefited from the averaging that SIP gives us. So don't go with lump sum when it comes to ELSS funds. However, you'll still have to do it if you have not done it, let's say last year, or at the end of the year you realize that you have not maximized your taxes. In that case, do it lump sum, but generally go with SIP, that's much better.
Should we invest in regular plan or direct plan? I have all regular plans now. I want to switch to direct, so asked. Please guide.
Okay, an extremely important question to answer. If you're investing in mutual funds, always go with direct plans. Don't ever go with regular plans. To me, this concept is completely nonsensical. You should never ever go with regular plans. They charge you more commission. I don't know for what reason. You don't even have to give them commission for that. Basically, whenever you want to invest in mutual funds, you can watch this channel. You have a lot of other influencers that can help you understand how to pick good mutual funds. Once you know which funds to pick, always buy it directly. If you use Grow or if you use Zerodha, they are direct platforms. They will give you direct mutual funds. You always use that. That will help you maximize your return, because even like 0.5% commission that you pay in regular plans creates almost more than a crore difference in a longer term horizon. Do not give that commission to them because it's illogical. They are not doing anything for you. If you want to know how to build a portfolio, I have a playlist on my channel. You can watch this playlist. It will help you understand how to build a great mutual fund portfolio. Once you know that, directly buy those funds using Grow or Zerodha, and these are direct platforms. Never ever buy regular funds. Never ever.
Withdrawing and then reinvesting means investing at higher NAV with less units, while if not withdrawn, the average NAV is less with maximum units. So if market raises or crashes, we are at better position than investing at higher NAV. Don't you think we are giving more importance to tax than our overall profit?
No, I think you misunderstood. Now tell me something. Let's say I own something which is of rupees 100 and at rupees 120 I sold it. I got a profit of 20% at 20 rupees basically. Now I again bought it at 120 rupees and sold it at 140. I again got a profit of, let's say, 20 rupees versus I had owned it at 100 rupees versus sold it at 140. Do you think it made any difference in my profits? It doesn't. Now this is a very simple scenario, but in terms of taxation and mutual funds and investments, it's a bit more complicated. Now when you sell a mutual fund, and the reason I tell this is because I want you guys to do tax harvesting, and this is for everyone. Every year we get this benefit of 1 lakh rupees, where if you have a 1 lakh rupee profit in long term capital gains, then you don't have to pay any tax. Otherwise you would have to pay tax. Now that is the reason I would say sell your mutual fund units. And to be honest, when I say sell it, this would be in the month of March, let's say, and then you would buy it again in the month of April. And you would realize, if you want to see data, go right now on Grow or Zerodha and check the data itself. If you see the data within like a week, the NAV would not change much. Let's say the NAV is 20.05. Within a few days, it might go to 20.10 or maybe even get reduced. Let's say 20.00. If it gets reduced, you have more profit. If it is a bit more increased, you'll have a bit more less profit, but that's almost negligible. What's more important here is we are doing tax harvesting. This 1 lakh rupee, we are not paying any tax, we are saving 10,000 rupees here, and that is more important. So I hope this clarifies your question, but this is very important for everyone else. Don't even think that if you're selling it and then buying it, you would be losing some money. You would not. You would only lose it if you sell it but don't buy it again. This is not what I promote. I say sell it and then buy it again in the month of April to do tax harvesting. I hope this clarifies.
I have option to edit the amount in my SIP fund. Is there any penalty for reducing the SIP amount? I want to shift some amount of my large cap investment to a new small cap fund by reducing the SIP amount for the large cap and start a new small cap fund. Please answer.
Okay. SIP is designed for flexibility. That basically means you can pause your SIP, you can stop your SIP, you can change your SIP amount, do whatever. There is generally no penalty. And that is the reason whenever you're doing SIP, you can always change it, increase it, decrease it, stop it, pause it, do whatever. This is the best benefit of SIP, is the flexibility. So feel free to do anything that you want, but always take a very conscious decision if you want to shift from small cap to large caps. I think it's a really good move right now. If you ask me, I would say it's a really good move because small caps and mid caps have given a really high return in the last 1 year. They seem a lot overvalued right now, and if there's a correction, they would fall a bit more. So in terms of strategy also, I think it's a good strategy. As of now, if you want to sell or reduce your SIP in small caps and move that to large caps, it's a good strategy and you can do it without any penalty. You can definitely go ahead.
We know the stocks of mutual funds, hence we buy the same stocks in the same ratio instead of keeping in mutual funds. Please advise.
Okay, a very interesting question because maybe 8 years ago I had the same idea. I was wondering if I can do this and maximize return. Now I'll tell you something, and literally an unpopular opinion. You can beat mutual funds a lot of times actually. If you know about stock market, you can actually beat mutual funds generally. Now why? See, when you talk about mutual funds and these portfolio managers, they deal with thousands of crores, let's say 10,000, 20,000, 50,000 crores. It is not easy for them to rotate the money. For example, if they have a lot of position in some stock, they don't buy stock just like us. They don't buy for 1 lakh or 2 lakh. They buy for, let's say, 100 crores, 500 crores, more than that. So it's not easy for them to sell the entire stock and move that capital to somewhere else. And that is the reason it is very hard for them to change their position. And hence, for a retail investor like you and me, we have this flexibility. We can rotate our capital very easily. It won't crash the stock. It won't, make it in the upper band or the lower band. So we have this flexibility. And that is the reason we should use this flexibility to maximize the returns. Now, if you follow the mutual fund, it would disclose the stocks once a month probably. And now, even if you buy the same stocks in the same ratio in your portfolio, you would not know when the portfolio manager sells it. And that is the biggest problem. Let's say there's some portfolio rebalancing happens in the mid of the month, you would not know about it, which basically means that you would get to know things very late. Let's say the portfolio manager changes the portfolio in mid of the month, and at the end of the month you would notice it, and then you would change your portfolio. It might get too late. Plus, it's not a good exercise, to be honest. It's kind of worthless exercise. You are better off doing your own research, buying your own stocks, defining your own portfolio, and that's way much better. Portfolio managers have to think about a lot of other things. They have to play a really safe game because they can't afford to lose money. So they don't invest in kind of riskier assets where they would generally want to invest, but because they are dealing with public's money, which is almost like thousands of crores, they can't do that. They don't have those flexibilities, and hence do not copy mutual funds. It's a really bad strategy. It won't even work. You won't even know when things are changing, and hence build your own portfolio, do your own research, and do that. Definitely you'll have more returns than any mutual fund. I promise you that.
When to book profit in mutual funds?
Okay, a short question, but a really complicated one to answer. Now, this is something where even the biggest investors have struggled with, which is when to book profits. Now, it is not about booking profits in mutual funds or stocks. It's still the same, right? When you buy a mutual fund, what exactly is it? It is still investing in stocks, right? So when you sell mutual funds, what essentially you are doing is selling stocks. Now, this brings us back to a stock market, which is when should we book profit in stock market? For this, the very first indicator I would want you to look at is PE ratio of the entire market. Now, first homework, go on screen right now, check the PE ratio of the entire market right now and look at it with the historical average as well. That's one thing. Second, you would book profits when you need money. Makes sense, right? It's illogical to book profits and then keep that money in the bank account. It doesn't really make sense a lot. Or if the market is extremely overvalued and you think there's no scope for any growth, then you would sell it. That makes sense, right, as well. And that is, you would calculate using PE ratio. There's one thing called as PE ratio, there's something called as MMI, Market Mood Index. You can use that to understand the sentiment of the market, and there are like 100 other options. I'm making my next video on this where I would explain when and how to book profits, and generally I would never ever recommend you to book the entire profit. Even when you book profits, when you think the market would not go up, it will, and you would be wrong most of the times. And that is the reason when you want to book profit, generally book, let's say, 20% of the profit, 30% of the profit. Now I'll give you a small example which will clarify all these things. I was purchasing Zomato last year. I had a lot of position in Zomato. I purchased it at a price of almost like 51 rupees. Then I kept upward averaging. I bought like 70, 80, even 100 rupees. So my average price was around 70 rupees. Now, so as of now, when I'm shooting this video in the month of July 2024, Zomato was almost 213 rupees, and I felt that it is kind of overvalued, and hence I started cutting my position. When I started selling Zomato, I have not sold the entire Zomato stake. What I have done is I have booked 40% of the profit. I would still keep the remaining 60%. So there are chances the Zomato stock would crash, but even today I believe in the long story of Zomato. 10 years from now, I still believe Zomato would be growing a lot, and hence I'm not cutting the entire position. But since it is kind of overvalued in the short term, I have booked some profit, and this is the same strategy I would suggest you. When you feel the market is overvalued, when you feel the stock is overvalued, book some profit, ideally 30%, 20%, 40%, and then use that money to invest again when the market crashes, and this will maximize your return in a longer term. I hope this helped.
Can you please suggest how to do tax harvesting for mutual fund?
Okay, an extremely interesting question again. See, tax harvesting is tax harvesting. It does not really matter if you sell mutual funds, if you sell stocks, if you are investing in equity market via stocks or via mutual funds, and if you get a profit of approximately 1 lakh in your long term, then this 1 lakh becomes non-taxable. Now this 1 lakh can come from mutual funds or from stocks. Even when you file ITR, it will be under the same bracket. MF and stocks does not really make a difference. What makes a difference here is short-term capital gains and long-term capital gains. Your long-term profit would be knocked off again long-term investments, and short-term profit again short-term investments. And that is the reason, even if you, let's say, sell mutual funds and get a profit of 1 lakh, and then you would sell your stocks and get a loss of, let's say, something, it is knocked off in the same bracket. And hence, when you do tax harvesting, calculate it overall. Your overall investment in equity market, if it is more than 1 lakh or less than 1 lakh, based on that you'll have to pay taxes.
Can you guide on which date NAV value is considered on date of placing order, or third day, or anything else?
For equity mutual funds and debt mutual funds, the cutoff time is 3 p.m. which basically means if you transfer funds and place your order before 3 p.m, you get the same day NAV, which is when the market will close, you will get the NAV of that day. If you place your order after 3 p.m, then you will get the NAV of the next day. So always keep this in mind. If you want to the same day's NAV, invest before 3 p.m. If you want the next day's NAV, then you will invest after 3 p.m. I hope this clarifies. I hope you found this video informative. If yes, please tell me in the comment section. Also, if you have any more questions, please post it. I'll try to come up with the part 3 of this video where I'll answer more questions. Now, in this channel, now we are focusing more on fundamental analysis. We'll start posting videos that will talk about how to analyze stocks and companies. So before that, please watch this video. This is an extremely important video that talks about how to build an amazing portfolio. Until then, keep investing in your dreams. Thank you.